Credit repair is something that is very simple and not simple at all. And what I mean by that is diving into your credit score, what that means for you, the different aspects that make up credit scores, and how that works for you in your day to day life and obtaining loans, apartments, all of that cool stuff. Something Alex and I were just talking about was the difference between a high credit score with a weak profile, and then the inverse of that, where you have a low credit score, but some strong reporting aspects on it. So, Alex, do you want to dive into that a little bit? What does a low credit score with a strong profile look like?
Yeah, so a lot of times um, you can have a 600 credit score, but you already have significant credit history with large accounts that have been paid off. So, for example, if you've had auto loans before that, exceeded, let's say $40,000 and it's paid off, you have credit cards that have exceeded, $10,000, $20,000, but they're paid off now, and that just shows the banks and the creditors that you're capable of acquiring credit and paying it back off. So a lot of times your score could drop from 700 to 600 with just one late payment. But if you're applying for a mortgage, a lot of times they'll oversee some of those late payments if they see that you do have a strong credit profile and you actually do have overwhelming uh, evidence that you actually are capable of paying back credit.
Yeah, yeah. An experience that I had, I come from the car industry. We had a gal that came in and she was a co-signer for somebody that had poor credit, just all the way around, lots of late payments, collections, charge-offs. She needed a co-signer. Her co-signer comes in and she's got a great credit score. It looks positive at first. She's got a 750. What we found is that we couldn't lend to her and get her a car loan because she was overextended. And what I mean by that is, although she had good payment history, when we looked at her debt to income ratio, she had maxed out credit cards that were over limits, tons of personal loans. And so there was no flexibility in her credit. She couldn't take out any more money because, according to the bank, um, she couldn't afford it. Now, that's something to consider too, and something that we help counsel you on is not just credit repair, but how to allocate your money correctly as well. So, according to her, when I interviewed her, she's got side money that's coming in, and that's how she's able to pay for these loans with side hustles and stuff like that. But we were unable to prove that to the bank, and so thus we couldn't get that person a car. That cosigner didn't work because she was overextended. And I think that's something important to look at is not just your credit, but how you're spending your money as well, and what can you prove as well. I think that's really important to obtaining a loan, a credit card, a mortgage, anything like that. A lot of people have asked me, and there are some myths that come with credit repair. One of them being that when you pay off a collection, it automatically gets deleted off your report. Well, that's not entirely untrue. Alex, do you want to talk about that a little bit? What happens after you pay off a collection?
Yeah, so a lot of times people think that just because you paid off a collection that it just instantly gets removed. That's further from the truth. Actually, it'll still stay there for 7 years. And unless we do anything about it, it's going to stay there. So we do want to dispute it, and as soon as it gets paid off, it's going to get a little easier to get it removed, typically. But technically, it could stay there for up to 7 years. Now, what you want to do as well, if you can negotiate terms with the collection agency before you pay it off, you could possibly negotiate the removal of the account itself from your credit history. Doesn't happen all the time, but it is a possibility. And at the worst case scenario, they say, hey, we're not going to remove it from your credit history. Then probably the next step after that would be you could still negotiate the amount that you're going to be able to pay to have that account reflecting zero. Depending on how much capital you have to pay off that collection, you can possibly get it negotiated to about 50 to 60%, typically. And hopefully, once it's zero, and you have no further payments for that collection, then you could possibly dispute it and hopefully be able to get it removed.
Yeah. Something and that was a misconception that I had as well. Obviously, I don't wanna go to collections. You should not go to collections just because you can't pay something. You have options. If you get a bill in the mail, a surprise hospital bill, and it's way more expensive than you know that you can pay, a mistake that I see happening often and one that I've made too is, well, I can't pay it, so I'm not going to. I'm not going to reach out. Then you start getting those 90 days late notices, those pink envelopes in the mail, and you think, oh, I'm just going to send it to collections and just leave it be. I'll pay it off later. I'll just negotiate with the collections company, get it lower. You can do that, but when you pay off that collection, it doesn't go anywhere, and that's something that is looked at when your credit profile is being looked at for what's called credit worthiness on if a lender is going to lend to you. And I think that's what is important to talk about today too, is your credit score is composed of a lot more than just the score that shows up. So, all the time when I was looking at credit profiles to decide what bank to send to ask for a loan from, we would look at the credit history. And so if I saw that, yes, your credit score is high, but you've got a couple late payments and you've got a bunch of collections paid off or not, that communicates to the bank that you are negligent in the way in which you pay things off. So, like the lady I talked about earlier, those are red flags that come up. I wanted to talk about something, kind of backtrack a little bit, because I get this question a lot as well, which is the difference between a hard pull and a soft pull on your credit, and how monitoring your credit could potentially hurt you. It's a misconception that I hear a lot about via Credit Karma, Experian. Alex, what would you say to people when they're questioning the difference between a soft pull and a hard pull?
Yeah, so a lot of people have the misconception that if you check your own credit, you're going to run a hard inquiry. That's not true. You can actually check your credit inquiries for free. It's called a soft pull. You go to Credit Karma and Experian.com, and they're going to give you all three bureaus for free. And you're going to see any, you're going to see your own report for free. And that does not cause any harm to your credit whatsoever. Now, where you do get a hard inquiry that shows on your credit history is when you're applying for any type of financing or loan. Like there has to be some type of credit that you're applying for, whether it's a credit card, a auto loan, a mortgage, and typically, um, a lot of times when you're buying an auto loan or you're buying a mortgage, you're going to get multiple inquiries typically within a 30-day period. You shouldn't be too concerned about running your credit several times within that period that you're shopping around. Your credit score won't get dinged as much if they're within a 30-day period. And the reason is because they understand that you're shopping around. But just know that those inquiries will stay on your credit report for at least 2 years, unless you do something about it, which we can help you potentially remove some of those inquiries that are not attached to accounts. So if it did not result into an approval, then that's where potentially we could help you get some of those removed. But typically, it's not a big deal if you have several inquiries on your credit. It's not going to slow you down as that much. Besides getting approved for credit cards like to have they like to see very few inquiries, and that's typically the only situation where I would suggest to kind of go hardcore and try to remove some of those inquiries.
Yeah. And that immediately you were talking about inquiries on your credit and when you're shopping around, and that reminded me of strategy. And I think strategy is one of the things that sets leverage services aside. There's a lot of credit repair companies that are just plug in and go, where you send out your credit report and they send out mass dispute letters, and then just hope that things start coming off of your credit. Leverage services takes more of a strategic standpoint where we sit and go through your credit report with you. We give you a realistic expectation of what we think we're going to be able to do for you. And then it doesn't stop there either. We also teach you and help you manage your money and how that's spent moving forward. A lot of our credit repair customers have talked to us before where we fixed their credit and everything, but we didn't quite talk strategy of how to spend their money. And that's something that we actually don't want to see again. We don't want to see you repairing your credit again. We want to set you up for success so that moving forward, you're not always in the red with your credit accounts. So, strategy is extremely important. We go in with a precision tool and help counsel you on not only how to get a derogatory account off of your credit, but then how to prevent that in the future.